Good morning, everyone. Welcome to the first of the parallel sessions. This session, which is in Rahura 101, is entitled PhD. So we've got presentations from 3 of our PhD students. It is indeed very much a hybrid, where our first speaker, who will talk in a moment, Clement, is actually physically here. Then we've got Helen, who's presenting virtually, and then I have a pre-recording from Richard, which I'll run. Although I do notice, Richard, that you are online, so I'll run your pre-recording. Yep, the key focus will be that each of you will have the 20 minutes to present, so it'll be one after the other, and then we'll have the Q&A session. Where for those of you virtually, if you raise your hand or something, if you want to ask a question and who it's of, and then whether it's Clement here, Helen or Richard can then respond to that question, with the aim that will be wrapped up by 20 past 11. And then we have a short break while we convert to the second of our parallel sessions. And as a reminder to you, if you want to continue in this parallel session, then just stay on the Zoom link that you've got. If you want to move to one of the other rooms Zoom link, then there is that little gap in time that you can change across if you wish to. So what I'm going to do now is to start the screen sharing process for Clement's presentation. And I will hand it over to Clement.
Good morning, everyone. My name is Clement. I'm a PhD candidate of the University of Canterbury. Today, my topic is the Doctrine of Earnings Hardship Taxation, which is one of the major contribution of my PhD dissertation, comprehensive anti-tax haven legislation for Australia and New Zealand, international comparative studies and reform. And my supervisors are Professor Adrian Shaw and Dr. John McLaren. These are the topics I will talk about today. Firstly, the introduction. That's the roadmap of my study. The problem here I'm looking at is describe so far all those global efforts against international tax evasion, especially by the use of tax havens, has failed the flow of funds to offshore tax havens. You can see the since the 1998 the OECD report on harmful tax practices after the Asian financial crisis, 18 years after the Panama paper came out in 2016. Then just last year, the Pandora paper came up in 2021. So it happens as it happens. Yeah. The research methods I made in my study made the literature review, comparative legal analysis, and case studies by way of face-to-face interviews. Then I'll come to recommendation for reform of domestic tax haven legislation of Australia and New Zealand, and I'm proposing a new taxing regime to tax offshore and onshore incomes according to their hardship rate. Now we look at so far the international developments in counteracting tax haven rules. Mainly to all is the G20 and the OECDs. The key trend in the since the 2009, they're looking at the era of banking secrecy was over. They're looking at banking secrecy. 2010, they're looking at improving developing countries' tax administration systems and policies and highlighting the relationship between non-cooperative jurisdictions as development. Then 2011, they're looking at setting up processes to identify non-cooperative jurisdictions and urge them to comply with the international standards on transparency and information exchange. And up to then, so far, in my study, I found they're just talking. Little actions has been done on those issues. Then in from 2012 through to 2020, the G20 is looking at international tax cooperation, and they also tasked the OECD with developing and implementing a new international taxation agenda. That's the BIPS, the Base Erosion and Profit Shifting project. Just in last year's G20 tax summit, the G20 is proposing an international agreement on a global minimum tax on corporate profits. That is, if a multinational got a certain amount of sales in, let's say, UK, a US multinational got a certain amount of sales in UK, then they will apply a corporate tax rate of 15% on sales. And that's it. Then the OECD's work against tax havens so far is defining transparency standards for tax information exchange, which are adopted when countries sign bilateral agreements. And then the BIPS project, the common reporting standard. You can see the BIPS project, the actual implementation of the BIPS project and the common reporting standard. Since in 2017, just right after the exposure of the Panama paper. And then after just shortly the implementation of the common reporting standard, the Pandora paper came out. I just need to introduce briefly the Panama paper and the Pandora paper. Both papers about a group of journalists who disclosed that a lot of politicians, heads of governments, and rich people around the world, they have moved high their assets or income in tax haven jurisdictions. My study is mainly based on case studies by way of face-to-face interviews. And I have done 12 interviews with the private sector, which include two listed companies on the Hong Kong Stock Exchange, tax barrister, practicing CPA, practicing CA in Hong Kong, Australia, some large corporates, small, medium-sized companies, and a practicing CA in Vanuatu, and a law lecturer in Vanuatu as well. Vanuatu is still one of the popular tax havens in the world. There are summarized 10 findings from these individuals. Number one, ordinary people have knowledge or at least familiar with popular tax haven jurisdictions and techniques for offshore tax avoidance. Number two, the use of tax havens for offshore tax avoidance by concealing assets and or income and profit shifting at the very least. Number three, easy setup within 24 hours if buying off the shelf and ordinary people can afford. Number four, people perceive government spending is uneven and tax systems inequitable. Number five, if tax haven jurisdictions were absolutely legal, everyone would try all means and their efforts to avoid tax. Number six, tax haven activities could not be stopped completely. Different countries have different systems and concerns. Not many jurisdictions will truly change their systems to adopt OECD's recommendations. This comment from the private sector is actually what I got from the New Zealand Inland Revenue, and even the New Zealand Inland Revenue also see that not many countries will comply with OECD recommendations. Number seven, the government never try and see if reduction in taxation and even distribution of wealth will actually increase revenue, because people will consider not revenue to avoid tax, and more people would like to contribute. Number eight, tax haven jurisdictions are still available, and tax haven structures for also tax avoidance still can be done, even though all the international measures against the use of tax havens in the last 20 years. Number nine, it would be more risk, hardship, and difficulties for earning income overseas, where taxation is inequitable. Number 10, finally, in tax, one system for all is inequitable, and a differential system to tax offshore income will encourage people to repatriate income from overseas back to their home country. The two interviews from the public sector officer will be from with the New Zealand Inland Revenue and the Australian Taxation Office. Both tax authorities are still think that they will follow closely with the OECD recommendations and strengthens their domestic generic legislative rules such as the CSC rules, and put more manpower and resources in anti-tax crime and evasion projects, and engage in joint task force with international community. In view of the above findings from the 14 case studies, which led me to think about an issue is we always talk about one law for all. But I don't think one law for all legal principle should apply to tax laws. For example, in criminal laws, if I instruct a dog to hurt somebody, I should get the same punishment, and I should get a fair trial. If I'm poor, I can get legal aid. So no matter I'm rich or poor, or no matter I'm Chinese or Kiwi, I should get the same punishment, or I should get a free trial. Same principle apply to commercial law, like contract law. If I breach the contract, no matter I'm rich or poor, I should get, if I breach the contracts, I should meet the obligations of the contracts. But in tax laws, this one law for all principles should not apply. Then this leads me to think about a system. It's called I compared income under tax law is like the dog. So tax systems tax all incomes the same by the individual progressive rates or by company tax rate. The tax system doesn't recognize the people's hardship to earn the income. That's why I'm thinking about proposing a new tax system called earnings hardship tax. And in Australia and New Zealand, we made reference to the ANSI codes, the Australian and New Zealand standard classification of occupations. And within that document, we classify all occupations into 5 skill levels. Then we may offer a discount to skill level 1, 2, 3 are the higher levels. Skill level 4 and 5 are the lower skill levels. Then we may offer a discount to the higher levels 1, 2, 3. Just like 30%, 20%, or 10%. And we also offer a discount if the income is earned from offshore by 20%. Then come to my conclusion is, although this may be somewhat arbitrary, at least it offers a fair taxing regime to recognize the different levels of risk, hardship, and difficulties in earning a particular type of income by allowing a tax incentive so that people would be less eager or even quit the tax. And of course, further research will definitely be required to determine more appropriate tax discount rates and mechanisms. We need to determine the increase in state revenues after implementation, probably by statistical modeling, and other tax legislation may be required to be revised. For example, the entity taxation. Let's say the company tax has been taxed at 28%, and then the dividends flow through back to individual shareholders. And how can we fit in the hardship discounts to those dividends? Thank you for your time, and any questions?
Thank you very much, Clement. So we'll hold any questions or comments until the end of our 3 presentations. So I'd now like to invite Helen for doing her presentation online, and welcome to you. And when you're ready to start to share your screen, that would be great. Thank you, Helen.
Alrighty, so just checking, can everyone see my slides?
We can hear.
Thank you so much. All right. Good morning. My name is Helen Ping from the Australian National University. Welcome to my presentation on this topic. Do analysts understand the complexities of corporate tax avoidance? I would like to firstly thank Dr. Sonali Wopler and Dr. Mark Wilson on providing valuable feedback on this working paper, and also thanks to ETA for the opportunity to present my research project. Let's get into it. My broader research question is concerned with whether corporate tax avoidance affects analyst focus accuracy in the Australian capital market. Analysts are sophisticated market participants who have the important function of providing an objective and expert evaluation of firms' likely economic performance to shareholders, stakeholders, and other stakeholders. Accuracy is a critical feature of analyst forecasts. By providing accurate information, in addition to disclosures like firms' financial reports, news from media, and any enforcement actions initiated by regulators, analysts play an important role in improving firms' information environment. But this improvement is only substantial if the forecasts are accurate. It seems that the ability of analysts to provide accurate and reliable forecasts of firm performance is challenged in the context of aggressive tax avoidance. I will expand my explanation of the reasons in the next section about hypothesis development. On top of this general question, I also attempt to figure out the mechanisms through which tax avoidance has an influence on analyst focus accuracy. I asked two specific questions. One, how does a firm's level of tax avoidance affect the ability of analysts to focus earnings? In answering this question, I compared the effect of tax avoidance on long horizon and short horizon analyst forecasts. Long horizon forecasts are focused at the beginning of the year, immediately after the announcement of prior year earnings, and short horizon forecasts are focused at the end of year, immediately before the announcement of current year earnings. Long horizon focus depend more on financial reporting quality, and short horizon focus depend more on information environment. And the second question that I asked is that, does tax avoidance affect the ability of analysts to focus after-tax earnings or pre-tax performance? The answer of this question actually depends on whether tax avoidance only affects accounting numbers or also the overall performance of the firm, and it could be both. Here comes my hypothesis. There are a number of reasons why I predict corporate tax avoidance to be negatively associated with analyst focus accuracy. First, firms are often required to implement their tax planning strategies into separate business activities and possibly in different tax jurisdictions, which increases organizational complexity and makes their earnings more difficult to interpret and predict. The increased organizational complexity is likely to result in lower information quality of the firm. Second, firms with higher levels of tax avoidance are expected to be less willing to publicly disclose details of their earnings and performance, as those disclosures may prompt investigation by the tax authority. If being investigated, their tax positions could be disallowed and their tax savings may need to be repaid in the future. And this leads to the third reason. Firms that are engaged in tax avoidance activities may have more volatile or less persistent earnings, which also makes it more difficult for analysts to provide reliable forecasts. For example, a firm's high reported earnings in a particular year may reflect the extent to which firms successfully pursue tax avoidance activities. But the high earnings may be just a temporary phenomenon because the risky tax positions of the firm are likely to be detected by the tax authority and reversed in future periods. Given my prediction of the negative association of corporate tax avoidance and analyst focus accuracy, I ask this further question as to what are the mechanisms through which tax avoidance affects analyst forecast accuracy. Tax planning increases firms' overall complexity and is expected to be associated with both the long horizon and short horizon focus errors, even though analysts may have different information about a firm when making these forecasts. So, as I said, the accuracy of long horizon forecast depends more on financial reporting quality. That is because those disclosures, so the financial reports, are the only or the best resources for the analysts at that time when they are making the forecasts. However, short horizon forecasts capture not only the information in the financial reports, but also the change in firms' information environment during the financial year, including things like ongoing disclosures of material changes and special events of the firm, other corporate communications, and supplemental reporting. As analysts have incentives to provide accurate forecasts, they tend to improve accuracy by gathering more information and incorporating the information into their earnings forecast during the financial year. That's the reason why, generally, short horizon forecasts are more accurate than long horizon forecasts. Also, given that higher levels of tax avoidance activities increase the difficulty for analysts to predict firms' future operations and tax outcomes, the association between tax avoidance and analyst forecast accuracy should be evident not only in the financial disclosures of tax information, so not just in the accounting numbers, but also in the firm's overall information environment, so analysts' overall accuracy of their earnings forecast. The most common type of analyst forecast that we see is after-tax earnings per share, but analysts also issue forecasts for other aspects of earnings as additional information about firms. If tax avoidance has impact on firms' performance as well as its tax expense and tax paid, I predict that tax avoidance will reduce the accuracy in analyst forecasts of pre-tax earnings, after-tax earnings, as well as implied tax expense forecasts. I do acknowledge that there are tensions in my hypothesis. It is possible that analysts recognize the complexities of tax information and adjust their forecast accordingly. Also, because a lot of tax planning strategies cannot be implemented within like a short time frame and thus require multiple year engagement by the firm, analysts might be able to use both public information and private information that they've obtained through ongoing interactions with the firm to predict current planning outcomes. Moreover, firms may be able to reduce their tax burden via strategies that result in little or no uncertainty and complexity, such as having tax deductions that are simply favored by the tax law or having operations in other low tax jurisdictions, even if there's no tax-related motivation for doing so. Engaging in this form of tax avoidance activities may not necessarily alter the firm's financial transparency or information environment. In this situation, firms' particular tax behavior may not really increase the difficulty for analysts to forecast earnings after controlling for other aspects of corporate complexity of the firm. So I do acknowledge that it is possible that the effect of tax avoidance on analyst forecast accuracy may be unobservable and difficult to document in an empirical setting. To test my hypothesis, I conducted an empirical analysis, and this is the model that I use. This is a simple OLS regression that I employ to test my hypothesis in the empirical setting. The dependent variable is analyst focus error, and it is measured as either one of the following 4 variables. So the short horizon absolute analyst focus errors, the long horizon absolute analyst focus errors, the absolute analyst net income focus errors, or the absolute analyst pre-tax income focus errors. My test variable, the most important independent variable, is this variable called tax, and it is measured in 2 different ways: tax volatility and tax aggressiveness. Measures of tax volatility are used to capture the extent to which tax planning and avoidance activities lead to general uncertainty regarding the future earnings of a firm. The more uncertain the firm's tax strategies, the greater the probability that the firm will have to reverse their tax positions and pay back their tax savings in the future. Firms that have greater volatility in their reported tax outcomes have less persistent earnings, and this will make it less predictable by analysts. In addition, I benchmark firms' tax behavior against that of their industry-sized peers, given that firms of similar size and belong to the same industry have similar levels of corporate complexity and tax avoidance opportunities. The fact that a firm is able to pay less tax compared to others in the same size and industry group indicates significant tax aggressiveness. Control variables and year and industry fixed effects are also included in this model. And I'm going to show everyone my control variables in the descriptive statistics session. But before that, let me just quickly talk about sample selection. I obtained firm year observations with sufficient individual analyst focus data from the Australian ABAS detailed history file to calculate the absolute value of the dependent variable. Following studies in the tax literature, I excluded from my sample those with negative pre-tax accounting profit, negative total tax expense, or negative cash taxes paid. Effective tax rates greater than 1, and also those with insufficient financial statement data to calculate tax avoidance variables and control variables. My final sample contains firm year observations that are distributed across 25 years and 17 industries. Now let's look at the descriptive statistics for all of my variables in the model. Firstly, the dependent variable, so those 4 variables in relation to analyst focus errors. Analyst median estimates of earnings per share for both beginning of year focus and end of year focus are within 0.4% of actual reported earnings per share. The short and long horizon analyst focus errors are not really substantially different for my sample, with the long horizon focus being slightly less accurate and a little bit more volatile, given the standard deviation is slightly larger. The standard deviation of pre-tax income focus error, which is 2.3%, are larger than that of the net income focus error, 1.7%, indicating that analysts may find it more difficult to predict firms' pre-tax performance than after-tax earnings. Then let's look at the test variables. It's worth mentioning that both the mean and median value of effective tax rates and cash effective tax rates in my sample are lower than 30%, which is the top statutory corporate tax rate in Australia. And this does not mean that all firms in my sample are engaged in some kind of tax avoidance activities. So these low effective tax rates could be attributable to a number of reasons, such as favorable tax deductions, extensive foreign operations, or active tax planning. Okay, so the mean effective tax rate volatility and cash effective rate volatility is 17.8% and 27.1%. So they are relatively high, suggesting that quite a number of firms in my sample do not seem to have persistent tax positions. And the distribution of the industry size adjusted ETR and cash ETR with standard deviation of 6.5% and 10.2% reveals the substantial differences in firms' total tax planning within industry and size groups. This is consistent with firms having similar tax savings opportunities, choosing to engage in different levels of tax avoidance. There are also control variables, like I said, that I include in the model to hopefully isolate the effect of tax avoidance on analyst focus accuracy. We can see that from the descriptions of those control variables that my sample is comprised of fairly large and profitable firms. So we can see that 53.3% of the firms in my sample are ASX 300 firms, and only 5.2% reports a loss. And there are significant numbers of analysts following those firms in the sample. So this table presents my main results. Consistent with my prediction that active tax planning increases the difficulty for analysts to focus future performance, I indeed find positive and significant coefficients on two of the tax variables of interest, ETR volatility and adjusted cash ETR, and both in the regressions with short horizon focus errors as dependent variable. This finding indicates that after controlling for other factors known to affect analyst focus accuracy, analysts will find it more difficult to predict earnings for those firms that have less persistent effective tax rates and those firms that pay less tax than its peers. This association is not only statistically significant, but also economically significant. If we look at these numbers, analyst focus errors increase about 1.5%, with one standard deviation increase in ETR volatility and 1.5% with one standard deviation increase in adjusted cash ETR. Given the importance of even a very small error in analyst focus for investors' decision making, the economic magnitude of the association suggests that tax avoidance has a meaningful impact on focus accuracy. Compared with the short horizon analyst focus accuracy, tax volatility or tax aggressiveness is not significantly associated with long horizon analyst focus accuracy, which is inconsistent with my previous prediction. But this result actually helps to disentangle the channels through which tax avoidance affects analyst focus. Recall that long horizon focus are focused at the beginning of the year and less accurate than short horizon focus at the end of the year, immediately before the announcement of current year earnings. Long horizon forecasts depend more on financial reporting quality. So it depends more on the quality of the firm's financial reports. And short horizon focus depend more on information environment of the firm. Tax avoidance plays a significant role in shaping the overall corporate information environment, which includes, but is not just limited to, the financial reports. If a firm's active tax planning increases the organizational complexity and earnings uncertainty in various dimensions of the firm's performance, its influence should be more apparent on short horizon analyst focus, and this is consistent with my finding. Continuing on the results section, panel B of this table shows a positive and significant coefficient on ETR volatility with either absolute analyst net income focus errors or the absolute analyst pre-tax income focus errors is the independent variable, indicating that firms with more volatile ETRs have greater analyst focus errors in both pre-tax income and net income. And also in table 6, panel B of my paper, which is available on the ETA website, there is evidence that accuracy of analyst focus of tax expense declines as firms become more tax aggressive. In combination, these results suggest that higher levels of tax avoidance are associated with reduced accuracy in analyst focus of pre-tax income, after-tax income, and implied tax expense, supporting my prediction that active tax planning has implications for both firms' tax outcomes and also operating outcomes. I also conducted a number of additional tests, but given the time limit, I'm not going to go into them in any detail. As I said, my working paper is available on the ETA website, so if you're interested, you can have a look at the paper. All right, in conclusion, I find that the ability of analysts to make accurate focus declines as the level of corporate tax avoidance increases. And that indicates substantial difficulty in analysts understanding the implications of tax avoidance for firms' earning performance. The difficulty is present in not only just the accounting numbers, so not only the firm's tax outcomes and after-tax earnings, but also in the focus of the firm's pre-tax performance. This finding that inaccurate analyst focus is a significant cause of corporate tax avoidance has implications for the under-sheltering parcel in the tax literature as to why some firms choose not to exploit tax avoidance opportunities despite the apparent large benefits that can be realized. If tax avoidance leads to tax savings, then why can't we just all engage in tax avoidance activities as much as possible? The reason for that is these benefits, these tax savings, come with substantial costs. And my empirical results in this paper suggest significant costs of corporate tax avoidance, in addition to those costs that have already been identified and documented in those previous studies. All right, that's all I have. So thanks very much. All comments and questions are welcome in the Q&A session. Thank you.
Thank you, Helen. Can you stop? Brilliant. Lovely. So, okay, so we're now moving on to our third presentation, which is from Richard, which is pre-recorded. So I'm just going to get that ready to go.
Hi. Hi, my name is Richard Taylor, and this is my presentation on company.
Just trying to get it to actually screen share. Sorry, everybody. Can someone say, are you able to see Richard's presentation? If anyone let me know.
Not yet, no.
Okay, sorry, got to work out why it's not coming up, because we did try these and they didn't work.
Hi, my name is Richard Taylor, and this is my presentation on company taxpayer behaviour in the allowed PDR. I'd like to thank my supervisor, Dr. Diane Crowell, for feedback on this.
Just checking, is that working now?
No, we're not getting it. I can share the screens and progress it through the while it's playing locally, if that makes it easier.
Yeah, I'm just trying to figure out what is not. Because it's just not showing up as an option to pick up. Whereas we practiced yesterday and it worked perfectly. Yep, so Helen stopped screen sharing. That's great. So there's no one there. I might just try one more thing.
Hi, my name is Richard Taylor, and this is my presentation on company taxpayer behaviour.
Got it.
In the Allowed PDR. I'd like to thank my supervisor, Dr. Diane Crowell, for feedback on this presentation, and thanks to Ada for the opportunity to present. The structure of the presentation is as follows: a brief introduction to my research question and research methodology, followed by an overview of the survey results drawn from 200 mining executives' responses to questions about how they respond to tax changes. Then an examination of the important role mining plays in Allowed PDR and the various tax changes that have informed that behaviour. This is followed by a look at the development of the Allowed PDR case study informed by the survey data and 15 interviews which are used to develop a model of company behaviour in response to mining law and mineral taxation changes in Allowed PDR. Finally, I briefly introduce material references underpinning this presentation. My broader research is on what is the relationship between company behaviour and mining law and taxation changes in a selection of countries in the Asia Pacific. I'm also interested in how companies talk about the way in which they respond and how they actually do, as well as the factors that lead to different responses in companies. The objective is to better understand the processes that determine company behaviour, be able to better predict that behaviour, and allow governments to better plan for it. The research methodology is overall a mixed methods approach, combining mainly qualitative data from interviews and quantitative data from surveys. In preparing the Allowed PDR case study, for example, the design was influenced by the outcomes of the survey of executives and long-form responses from those with experience in Allowed PDR. The survey was refined through a pilot survey, and a similar approach was taken with the interviews. The learnings from each stage were used to inform the following stage through a feedback loop. The quantitative survey data was generated in Qualtrics and analysed using IBM SPSS through descriptive statistics and regression analysis. The qualitative data from the surveys and interviews were then coded in vivo software and analysed using a grounded theory approach, which I'll explain for those who are not familiar with it later. As I said, the survey was developed in early 2020 and pilot tested and delivered in mid-2020 in accordance with ethics approval conditions. Mining executives with experience in the target countries were contacted via email, social media, referral, and through chambers of commerce. More than 600 people were approached directly or indirectly through this process. The survey consisted of 29 closed questions, and I only have time to talk about one today. Most of those questions were collected metadata on variables identified from the individual taxpayer compliance literature, which many of you will be familiar with, and areas which may have been determinative of company behaviour, such as company strategy. Respondents were also asked how their company would respond to a series of scenarios involving mineral taxation increases. Before I get to the surveys the findings from the survey, a few comments on how the questions were arrived at. Starting point in designing the survey questions was to look at within the taxpayer compliance literature to see which variables had been shown to influence how individuals responded to tax changes or filling out tax surveys, and to see if there was an overlap between factors affecting individual taxpayer compliance behaviour and corporate taxpayer compliance behaviour, the individual going to the group, really, and group decision making. I guess in the mid to late 20th century, individual taxpayer compliance behaviour was considered largely in terms of, at most, a tax evasion, and as a somewhat automatic calculation of the size of the fine and the likelihood of getting caught. It was work by Gary Becker on rational criminality, which led to the Allingham and Sanmo model, which captured this trade-off between likelihood and consequence. Since then, there has been an explosion of interest in the factors affecting individual taxpayer compliance. Variables examined have included age, gender, the influence of tax preparers, amnesty, source income, occupation, etc. There are some excellent literature reviews summarizing these studies, such as Young et al. Being the most recent and referenced at the end of this presentation. Taxpayer compliance behaviour has also expanded beyond tax evasion to include other behaviours such as tax avoidance and tax planning. Many of the variables and other studies draw from behavioural economics and psychology works popularised by Daniel Kahneman and Emil Stefetsky in publications such as the bestseller Thinking Fast and Slow. However, while many of the studies have focused on individual taxpayers, comparatively few tax studies have looked at corporate taxpayers. Young's study found only 9% mentioned business taxpayers. A review of those that do look at businesses show that the majority look at small businesses where ownership and control are almost one and the same and akin to individual taxpayer compliance. Understanding of large corporate taxpayers remains underdeveloped when compared to individual taxpayers. Returning to the findings of the survey, as just mentioned, individual taxpayer compliance behaviour used to think of tax evasion as somewhat automatic calculation of size of the fine and likelihood of getting caught. However, the data suggested the response was far more complex, and we now know this to be the case due to the many studies looking at these variables. Similarly, economic and mineral taxation literature suggests that when mineral taxation increases, there is almost an automatic reduction in investment and exploration. While the survey found some support for this in the responses, hence the slide that I'm showing at the moment, the data reveals that company response is likewise complex, and this complexity is not captured in the literature. In the survey, when asked how their company would respond to a mining law or mineral taxation increase, the responses were almost evenly spread. Around 40% would only reduce investment about half the time, almost a quarter would never or almost never reduce, while 33% would most of the time, but only 3% would do so always. From the macro survey, which gave some insight into the complexity of mining company behaviour, the next step was to look at this decision making in the context of a country, in this case, the Lao PDR. But before I get into the case study, one of the things to dwell on is why does mining company behaviour in response to taxation changes matter in countries like the Lao PDR? Well, since the mining booms that commenced at the beginning of this century, mining revenues have become increasingly important to the country, Lao PDR, and understanding whether companies will pull back on investment important to future economic growth when taxes changed. On the left, you see the rising importance of mining revenues to countries in several countries, including Lao PDR and Australia for comparative purposes, which is somewhat, in some measures, more important to minerals are more important to Australia than they are to Lao PDR. But in general, for developing economies, these revenues are important sources of funding for the major growth areas of spending in health, education, and the environment. The increased demand for many metals, occasioned by the energy transition away from fossil fuels in favour of renewables, may see resource revenues continue this rise in importance within developing countries. The metal rich is more evenly distributed than potentially historically with oil and gas, which were concentrated in a few smaller economies. In putting together the case study and trying to go behind the stats, Lao PDR has a fascinating history of modern mining, which came through in the interviews. I've plotted here major chronological events in Laos on a timeline shaped by mining sector revenues paid by the sector to the government as a percentage of GDP. The narrative actually starts slightly before the timeline proper, with vast incentives being granted to foreign investors in the 1990s, as the Lao PDR sought to recover from the collapse of communism in Europe and a pivot to Western aid and capitalist market systems under what it called the new economic mechanism. The delay in response between these incentives and the first revenues can be seen with the first major gold mine only entering production in 2002, which is Oxiana's Sepon gold mine. The sector's contribution really took off, though, with the two phases of the commodity boom either side of the global financial crisis. The speed and size of growth caused significant concerns within government, resulting in new mining laws, tax measures, and moratoriums on mining exploration coming rapidly over that period. At the same time, changes in ownership saw companies enter and exit the Lao PDR, some due to market conditions, takeovers, or strategic buyouts. Throughout these changes, investment was rising. Companies were focused largely on growth over profitability, and allowed government pursued its own licensing exemption model for preferred companies. Only when the existing assets had reached depletion stage and new exploration had not been possible by the major companies due to the moratorium, the sector declined in both absolute and relative contribution to the local economy, which along with a pattern of which has been seen in other countries. In order to identify potential variables influencing the behaviour of executives, knowing the diversity of response encountered in the survey results, interviews were undertaken with 15 mining executives coded in vivo and analysed using grounded theory. Just a little bit on grounded theory for those not familiar with its use. Grounded theory was discovered by Glasser and Strauss, and a variation by Strauss and Corbin is used in this research. Grounded theory is an inductive process whereby the data is gathered, in this case interview data, is openly coded, a process of categorization, and then axial coded, where linkages are established between properties and dimensions, but within the feedback from interviews. And finally, they're selectively coded, where a narrative is created and a theory emerges grounded in the data. The process involves multiple readings and a reflection on the data, informing refinements in the coding process as you go through. There are a number of strands of grounded theory. The original Glasser approach emphasized no a priori preconceptions. However, Strauss and Corbin allows for more a priori information, and this is the approach that's been adopted in this research. From these interviews, 70 separate codes were developed and refined down to 5 major themes and 13 sub-themes. Main themes dealt with some complex issues, sometimes separate from taxation, but absolutely central to the strategic decision-making that establishes a rulebook for company taxpayer behaviour. The first was prospectivity, how much unbounded and therefore unquantifiable optimism and upside exists in the minds of executives about the future. Related to this was how much sunk costs had been, meaning that if capital had been invested, it was largely discounted from the equation going forward. So how much upside exists from these cash flows and generated profits, and their ability to be unquantified in the future was an important theme behind decision making. The second was lobbying, rather than a one-off change where each mining law and tax change is seen as part of a broader negotiation and narrative with the company as a player in the politics of the country and its own future. Third, company strategy, leadership and company culture could lead even companies with similar assets and outcomes to different behaviour. Fourth, executives operate in areas of high uncertainty. It makes them cautious of change and more likely not to change what they do in terms of operations and countries of investment, creating a rigidity in behaviour at the status quo. Fifth, taxation was seen as a financial metric and separate from environmental or social or other governance matters, and there was a distinct change in the way matters were dealt with when you were looking at an ESG or in a financial and taxation risk perspective. What behaviour was acceptable and the relative importance of both company strategy and decision making varied between how the decision was characterised. Using the results of partial model, partial only as it is to be combined with the other case studies in developing the full model, was developed in order to examine the central phenomenon, in this case that company behaviour in the mining sector appeared to be surprising and more complex than that predicted in the classical and neoclassical economics literature, i.e. that taxes go up, investment and exploration will fall. Firstly, in the model, the causal conditions were the crisis-driven rapid opening of the Lao economy in the 1990s, leading to a big influx in exploration that brought investment on just as the same time as the commodity prices peaked around the GFC. The resulting mining surge caused concern in the government that the mining sector was growing too fast, damaging the environment and seeing benefits shift overseas. These concerns were echoed in the United Nations, the World Bank and International Monetary Fund reports. The government introduced a series of progressively more restrictive mining laws, taxation changes and moratoriums, but honoured existing concessions and somewhat dichotomously allowed for continued exceptions and licensing new exceptions throughout that period. As I said before, right at the core of this, the central phenomenon is that mining companies did not behave how the economic literature predicted, and instead have been less sensitive to changes and more responsive to things such as commodity prices and more successful lobbying for exemptions or licenses from those changes. Third, this context has been an evolving legal system and increasingly sophisticated taxation system that has increased taxation on non-exempt businesses, but struggled to see greater compliance in operations and of production under the new regimes without those exceptions. Fourth, there has been significant intervening events beyond commodity price booms and busts. The nature and pattern of investment has changed several times, from large multinationals to junior ASX mining companies, now to Chinese state-owned corporations, and a growing domestic and regional small-scale mining sector that has significantly changed the people involved and the nature of the companies involved in allowed PDR, and therefore the strategies they employ. Fifth, companies have four real options in how they behave, rather than what we've seen in the neoclassical economic literature. They can resist the change, mitigate it, reduce it, do nothing, or a mixture of two, or all at different times. The complexity of the variables and the range of responses see that companies focus on lobbying as the cheapest strategy to delay the onset of changes and try to mask changes where they can or cut deals with the authorities. Mining companies expect and are able to maintain a dialogue with government at its highest levels and are an active participant in the process rather than a recipient of change. Whether a company actually ever reduces investment and exploration as a result of a mining law or taxation change depends, I guess, on the success of these other strategies. However, finally, the consequence of this system or this model is that the government has not seen widespread uptake of the tighter mining laws, nor the implementation of the moratorium through the widespread use of its licensing exemptions and enforcement difficulties. Well, the companies have seen the operations approach the end of their mine lives, and no new resources have been found to expand or continue their life in country. Many have in fact sold their interests to others with different views potentially on the future. There are several sort of theories emerging and next steps for my research. It's led to the development of several theories that broadly follow changes that have happened in the individual taxpayer compliance space. That is the recognition of the importance of understanding different variables contributing to different taxpayer outcomes. In summary, company taxpayer is more complex rather than simple or automatic after mining law or taxation changes, and can result in a range of behaviour. Models of tax changes need to allow for this when considering the impacts of any of those changes. Allowed PD executives may be influenced by many variables specific to the nature of their company's assets that make them more or less sensitive to changes. Understanding the ways companies differ and how this relates to behaviour is important to understanding the potential impact of tax changes. Company behaviour may also be influenced by external contextual pressures in allowed PDR. The relative importance of these factors may vary over time and for each company. Finally, a new mining law or taxation change may be viewed by executives very differently depending on whether a mining company is in exploration, financing a new mine, or in production, given the different factors at play. Partial model that I've developed will inform my full model development and theory development and conclusions for my thesis. Next steps are completion of the analysis of the interview data for Indonesia and Papua New Guinea as other case studies. And I will look forward to highlighting the potential variables influencing company behaviour in the mining sector so that we can increase the richness of the literature around company and group behaviour, as has happened in the way that individual taxpayer compliance literature has advanced. Finally, just looking at some of the references there for those who are interested in the different papers that I've mentioned, or into the use of grounded theory as a methodology for looking at qualitative research in the social sciences space. Thank you again for listening to my presentation. Any questions?
Great. Thank you very much, everybody. And now we've got about 10 minutes for Q&A, and I saw was it Helen? Did you have a hand up? No, not there now. That's all right. So it's open to anybody who would like to have any questions or comments for any of our three presenters. Okay, Brett.
Hi, Helen. I really enjoyed your presentation. Congratulations to all three presenters. Helen, with your results, do you think profit shifting and like transfer pricing is part of the reason for analysts really struggling to predict the profit figures of the different companies? So just profit shifting, how that could really affect the company's profit and affect your results, or be part of the story there?
Yeah, definitely. So I think profit shifting, which is one key tax avoidance strategy employed by a lot of Australian firms, that definitely makes it more difficult for the analysts to understand the accounting figures in the financial reports and making like more accurate analyst forecasts. So yes, profit shifting is definitely part of my story, but I'm not really just limited to a particular type of tax avoidance strategy. I'm looking at just tax avoidance broadly and as to how that might affect the analyst forecast accuracy. So I found that in general, analysts, even they are quite sophisticated, very skilled market participants, they still find it difficult to understand the firm's financial reports and the firm performance if the firm engages in tax avoidance.
Thank you.
Thank you, Brett.
Okay, anybody else got a question or comment at all? Okay, not seeing hands up. There's one thing I was just going to ask Clement, who's here, is his proposal, I guess if you followed the presentations, is a very radical departure from our sort of current approach that all income is generally income. It might be taxed differently if it's in a different entity. Is how do you think the general populace would react to some of those ideas of discounting or treating certain income in a different way? Clement, you want to comment?
I think further research need to be done to see whether the discounting the tax on by way of hardship will definitely increase the revenue.
Yep, I agree with that. But say I'm just an ordinary person and I see that this becomes government policy. How do you think the ordinary populace might react to something like that? Do you think this is they might be considering favouring wealthy people, large business?
Oh, yeah, actually, from my interviews, the participants also made the comment that they don't think earn more, pay more system is equitable, is inequitable. So they'll prefer if the tax system, if we're looking at how hard we earn income and then if we get less tax, then people will be more willing to pay tax and not to avoid tax.
Okay. I guess that then will be calling into question now some of our long-held principles about how we treat equity and that whether we believe there should be like progression in rates for those that earn more. So I think it's a very interesting idea, and it certainly might be favourable to some of those that would benefit from it, but it could be a very hard sell for the wider population, and we'd have to think about what that might lead to in terms of potential compliance. But I understand those are obviously issues to look at in the future. So I won't hog any longer. Is there anybody else who's got a question or comment or anything? Okay, well, I got one thing I might ask Richard with his presentation. Obviously, you're still working through and looking at some of the different case studies. Do you think there might be differences, particularly between, I mean, you've got developed and developing countries as well, where the way that the mining sector works, there could be more influence. For example, this is possibly when it comes to developing countries, they rely a lot more on what the mining sector investors create maybe than what it might have been, say, in Australia. Any comments on that?
Yeah, Australia's a fascinating example as well, because many of the same players that are involved in the developing country industry also have significant operations within Australia. And Australia is probably more mineral dependent than many other developing economies. And that's sort of been a debate in Australia about the diversity of our economy, having I guess, a developed status, but with many of the similarities to a developing country reliance on natural resources, agriculture, in terms of those sort of dynamics. I think definitely each of the different countries will have different aspects and be able to explore many of the different variables associated because they have very different histories. The types of interventions they've had within the economies have been very different. So for Indonesia, for example, it has been a very heavy drive for national ownership, national equity, rather than nationalisation. Within PNG, you have a profit sharing or production sharing approach being looked at again, as well as a super profits tax. Each of those can elicit very different types of behaviour within companies, and I think it will add to the richness by adding sort of the 3 case studies together. But I think underlying at the core, and where I am with the research at the moment, is that the complexity of that behaviour continues to be. There are many other drivers for companies to be able to continue for growth and look at exploration, such that changes in taxation, the sector is much more immune to changes than the literature would suggest. So I think the robustest of those findings will be important to the tax authorities in countries with significant mining sectors.
Thank you, Richard. And I guess we've maybe got 1 or 2 minutes left, but if anyone has got a last question or comment that they would like to make, I won't draw things out, obviously, if there isn't. Don't see any hands going up. So if you can join with me both virtually and here and thank our 3 presenters, Clement, Helen and Richard, for their presentations and for keeping us very well to time, which is so much appreciated. So thank you. Okay, so we're going to take about a 5-minute break. So I'll shut this session down and you can choose to stay on this one if you want to hear the next 2 PhD students presenting, starting about 11:45 New Zealand time, or you can change to one of the others if you choose. So again, thank you all very much, and I hope to see some of you soon.